We want to take a look at markets here and the 2-year and the 10-year Treasury yields this morning. They're pulling back, but still at elevated levels. Look at this. The 10-year's now down 2.5 basis points, sitting at a level of 4.909%. The 2-year's at 5.07%. This is down 1.7 basis points this morning. But we, of course, are waiting on the Federal Reserve's two-day policy meeting decision today at 2 p.m. Eastern. Federal Reserve Chairman Jay Powell will then speak. Following the rate decision, he'll speak at 2:30 p.m. Eastern. And it could be a market mover. Joining us right now to get ahead of it is the Wall Street Journal's chief economics correspondent. He is author of The $1 Trillion Triage. Nick Timiraos back with us. And Nick, great to see you. Thanks very much for being here this morning. And I want to refer to your piece out in the Wall Street Journal where you write there's two big questions for the Fed today. One will center on what officials want to see. Another will be what it would take for officials to conclude they are moving in the right or wrong direction. What are you expecting, Nick? And walk us through more of that.
Well, thanks for having me, Maria. I think we will hear the Fed Chair, Jay Powell, at the press conference this afternoon come up with as many different ways as possible to say, we'll see. They are in wait-and-see mode right now, and there's not a lot of reason, in my view, for them to give away anything about, what they plan to do here, because they are going to be guided by their forecast and whether the data come in and contradict or validate that forecast. So I think the big question here is going to be, where do they set the bar for a December rate increase? Because nobody expects them to raise interest rates today. And that's where all the questions, I think, are going to be focused at the press conference.
Yeah, and in that same vein, I'm wondering if the decision today to have another pause will alter the path of the rate hikes going further, because we know that there's another meeting in December. What happens then? Is it all about the data, Nick? Because the data's been pretty good, right?
Yeah, the data's been good, Maria. If you look back to the last time they raised interest rates, which was in July, or even back to June, they really decided, I think, at the June meeting they were going to raise rates in July. So what's happened since the summer? Three notable things have happened. One is that the U.S. economy has been very resilient. Consumer spending has been strong. Hiring has been better than expected. Do you remember that banking crisis back in March? The stresses are still there, but we haven't seen evidence that that's really slowing down the U.S. consumer. So that's number one. Number two, inflation has been much better. We're seeing, 6-month annualized core inflation readings below 3%. That's different. That's new. That's progress. And then the third thing we've seen, and this really began in August and it continued over the last month and a half, is the sharp sell-off in the bond market, the rise in 10-year Treasury yields. You have mortgage rates, 30-year mortgage rates flirting at 8% right now. We haven't been there since 2000. And so, these things kind of all cut in different directions. Inflation coming down tells you maybe you don't have to move, but you don't know if that's going to continue because the economy's been strong. But then financial conditions are tightening, so maybe that offsets some of the stronger growth. And so that explains, I think, why they're in this wait-and-see mode right now for interest rate policy.
Well, we're still expecting things to slow down as a result of the rate hikes that we've gotten. I mean, there are some people who are still expecting a recession in the first half of next year. What are you watching in terms of this macro story slowing down as your favored indicators?
Well, I think the inflation data is first among equals right now, Maria, because if you get stronger growth, as we've had, but inflation continues to come down, the Fed's sort of workhorse models, they tell you that when you have tight labor markets, you're going to see inflation pressures build. But if things are happening in the reverse, then maybe you don't have to do anything right now. So core inflation, core inflation, core inflation, I think that's where the focus will be. But then you have other data that will help sort of signal where that might end up. We're going to get the job openings report today. We're going to get another job report on Friday. And those are important as well.
Yeah. And then there's wages, right? The employment cost index growing at a faster pace than expected last quarter, up 1.1% year over year. Wages and benefits up 4.3% in the third quarter. Nick, you've got another piece out talking about Fed officials and wage growth. You say Fed officials think wage growth needs to slow to about 3% to 3.5% a year for inflation to fall to their 2% target. The big question is what it will take for that to happen, particularly given the brisk consumer spending and hiring in recent months. Nick, layer onto that all these strikes that we're seeing and, demands from labor that they want their wages up. Isn't that also playing into this inflation story?
Yeah, if you take that employment cost index report that came out yesterday, that's a very high quality piece of information, especially that's how it'll be seen at the Fed, because it adjusts for certain shifts in the composition of labor. What it really means, though, Maria, is that you can look at this as a glass half full or a glass half empty situation. And what I mean by that is wage growth peaked last year at around 5.6% for the private sector in that survey. It has come down now to about 4.3%. And as you said, the Fed would see something consistent with their inflation target with, wages in the low threes. So, the glass half full interpretation is, look, we're more than halfway there in terms of closing that gap from 5.6 down to the low threes. We're at 4.3. That's great. The glass half empty view, Maria, would be that, well, you're still high. I mean, you're still running right now with wage growth consistent with inflation in the threes, and the Fed has a 2% target. So do you sort of put more on the trend that this is, coming down? Or do you say, well, what if it goes back up here? What if it stabilizes at this level and we have 3% inflation going forward instead of 2%? That won't be as painful as the situation we were in last year with much higher inflation. That was an emergency for the Fed, but it could still make for some complicated decisions.
So how do you read the move in rates? The 2-year, the 10-year? 5% has been a pivot position for some people on Wall Street. They're looking at 5% on the 2-year Treasury or on the long bond, or even the 10-year, which is close to 5%. And they're saying, I want to take money out of stocks and move it into fixed income. I'm wondering if the October jobs report is going to have a big impact here as well. Economists are expecting the jobs numbers to come in 180,000 jobs added to the economy for the month. The unemployment rate up to 3.8%. What are your expectations here, and what about those rates?
Yeah, I think the big question still on this is this a growth and a fundamentals story? Are yields rising because investors are taking a recession out of their forecast for next year, and maybe inflation is going to be a little bit higher for longer than they thought, and so interest rates are going to be higher for longer? The stronger growth story would have one set of ramifications behind it. The other is that this is more of a Treasury supply and demand story, that you have certain buyers, including the Fed, foreign investors that are stepping back from buying duration, longer dated securities right now at a time when you just have more and more supply. And if it's a supply story, then that suggests the term premium is rising, and that means maybe the Fed doesn't have to do as much. If it's a growth story, then maybe it means the Fed has to do more. One tail risk I wonder about here, Maria, this economy has been so resilient. 500 basis points of rate increases, quantitative tightening going quite aggressively, a banking crisis in March, and it hasn't slowed down. So what if we get through this latest episode of tightening in financial conditions and the economy is still doing well? Does that suggest that we aren't talking about just one more Fed rate increase, but would the Fed have to do, several more? I think that's a tail risk for now, but it's one you sort of wonder about in the back of your mind.
Well, which is why you wrote the Fed officials debate whether they have raised rates enough. There's a debate within the Fed. Nick, what's the most important thing you're going to be watching today from Jay Powell when he speaks at 2:30?
What I'll be listening for is what clue does he give, if any, about December. Like I said, he's going to say proceed carefully, patience, we'll see, as many times as he needs to try to keep his options open. They don't want to get locked into anything here, and they don't want to rule anything out. But, Powell can sometimes provide some nuance that sort of gives you some tea leaves around where their head is at right now for the December meeting. So that's what I will be most focused on.
All right, we'll look at that. Nick, good to see you this morning. Thank you.